Money can be a powerful tool, but only if you know how to make it work for you. I've spent my career as a portfolio manager, where my primary job was managing risk, keeping portfolios balanced and growing steadily, even in the face of market uncertainty. I know how I would invest $10,000 for the best possible and safe return. And today, I will show you exactly how you can too. In the end, I will show you a portfolio that has the potential to turn $10,000 into over $300,000. For me, it all starts with building a core holding with an index fund. The first step in investing $10,000 wisely is to establish a strong foundation, and that's where index funds come into play. Now, you might be wondering why I'd recommend putting a substantial $7,000, 70% of investment, into a single type of fund. The answer lies in the stability and long-term growth potential of an index fund, specifically one that tracks the S&P 500. The S&P 500 index includes 500 of the largest and most stable companies in the United States. These are companies like Apple, Microsoft, and Amazon, industry giants that have stood the test of time. By investing in an S&P 500 index fund, like FXAIX or VOO, I'm essentially buying a small piece of each of these companies. This provides broad exposure to the market, which helps mitigate risk while still offering solid returns. My personal preference is FXAIX because of its low expense ratio, which is crucial for maximizing returns over the long term. A lower expense ratio means that more of my money stays invested, instead of being eaten up by fees. Over time, this difference can compound, leading to significantly higher returns. But let's not just take my word for it. Let's look at the numbers. FXAIX currently has a dividend yield of 1.26%. Over the past decade, the average dividend growth for FXAIX has been an impressive 11.15%. This is crucial because reinvesting these dividends can supercharge my returns over time. On top of that, FXAIX has seen an average share price appreciation of 10.68% over the past 10 years. This means that I'm not only earning dividends, but the value of my investment is also increasing at a healthy rate. It's this combination of income and growth that makes FXAIX an ideal core holding for my portfolio. Now, why allocate $7,000 to this fund? Because this core holding is designed to be the backbone of my investment strategy. The S&P 500 has historically delivered solid returns over the long term, and by investing in a fund that tracks it, I'm aligning my portfolio with a proven performer. Whether the market is soaring or hitting a rough patch, having a large portion of my portfolio in a diversified, stable investment like FXAIX gives me peace of mind and a strong foundation to build on. In simple words, by placing $7,000 into FXAIX, I'm setting up a core investment that is both stable and capable of significant growth over time. This isn't just about today or tomorrow. It's about building a foundation that will support my financial goals for years to come. With my core holding established, it's time to think about growth. The next step in my strategy is to allocate $1,500, or 15% of total investment, into a small cap ETF, like the Vanguard S&P 500 Small Cap 600 Value Index Fund ETF, or VIOV. Now, you might be asking, why small cap stocks? Small cap companies are typically smaller, newer firms that have a lot of room to grow. They haven't reached the scale of the giants in the S&P 500 yet, but they have the potential to deliver higher returns as they expand. Historically, small-cap stocks have outperformed their larger counterparts, particularly during periods of economic recovery and growth. VIOV is an excellent choice for tapping into this potential. It's a fund that tracks the S&P 500 Small Cap 600 Value Index, giving me exposure to a diversified group of small-cap companies that are considered undervalued by the market. Essentially, these are the companies that the market hasn't fully recognized yet, offering a chance to buy in at a lower price with the potential for significant upside. But let's talk specifics. VIOV currently offers a dividend yield of 2.25%, which is higher than what you'd get with large-cap stocks. This means that while I'm waiting for these companies to grow, I'm still earning a steady income. Over the past decade, VIOV has seen an average dividend growth rate of 16.87%. On top of the dividend income, VIOV has delivered an average share price appreciation of 6.48% over the last 10 years. With small cap stocks in my portfolio, I'm not just chasing the highest returns, I'm balancing out my investment with assets that don't always move in sync with the broader market. This can help smooth out the bumps along the way. Here's why this is important. Small cap stocks tend to be more volatile than large cap stocks. This means they can experience bigger swings in price, both up and down. But with that volatility comes the potential for higher returns. By investing $1,500 in VIOV, I am tapping into this potential growth, while also diversifying my portfolio beyond the large cap focus of my core holding. Another key benefit of small cap stocks is that they often respond differently to economic changes compared to large cap stocks. For instance, during times of economic recovery, small cap companies bounce back faster because they're more nimble and can adapt quickly to changing market conditions. This makes them a valuable addition to a well-rounded portfolio, as they can provide growth opportunities when large cap stocks are stagnating. However, it's important to manage your expectations and understand the role that small cap stocks play in your overall strategy. While they offer the potential for higher returns, they also come with higher risk. That's why I'm allocating only 15% of my investment to this category. It's enough to benefit from the upside, but not so much that it exposes my entire portfolio to unnecessary risk. With the core of my portfolio secured by a strong index fund and growth potential added through small cap stocks, it's time to focus on stability and income. The final $1,500 of my $10,000 investment will go into a Dividend Aristocrat ETF, specifically the ProShares S&P 500 Dividend Aristocrats ETF, or NOBL. So what exactly are Dividend Aristocrats? These are companies within the S&P 500 that have not only consistently paid dividends, but have also increased their dividend payouts for at least 25 consecutive years. The NOBL ETF is designed to track the performance of these dividend aristocrats, offering my portfolio a diversified portfolio of high-quality, dividend-paying companies. These aren't just any companies. These are the best of the best when it comes to consistent dividend growth and financial stability. The ETF currently offers a dividend yield of 2.04%, which is higher than my core holding in the S&P 500 index fund. Over the past decade, NOBL has seen an average dividend growth rate of 15.98%. In terms of share price appreciation, NOBL has delivered an average of 8.31% over the past 10 years. By investing $1,500 in NOBL, I'm adding a layer of diversification that goes beyond just owning different types of stocks. Why is this important? Stability and income are key components of a well-rounded investment strategy. While growth stocks might grab headlines with their potential for high returns, dividend aristocrats offer something just as valuable: the ability to generate income consistently, regardless of market conditions. This makes them an excellent choice for investors who want to build wealth steadily and securely over time. Future projections and market outlook. With my portfolio now strategically diversified and my asset allocation established, it's time to look ahead. One of the most exciting aspects of investing is projecting how this investment can grow over time, especially when you're taking a disciplined, well-planned approach like reinvesting dividends. Starting with my portfolio's current standing of 70%, 15%, and 15%, I would have a dividend yield of 1.53% across my investments, combined with a solid average dividend growth rate of 12.73% over the past 10 years. On top of that, this portfolio has seen an average share price appreciation of 9.69% over the same period. Looking forward to just 1 year from now, my initial $10,000 investment could grow to approximately $11,122. After 10 years, this portfolio could be worth $29,546. At the 20-year mark, my portfolio could be valued at approximately $92,211. But the real magic happens when we look at the 30-year mark. By staying committed to this strategy, my $10,000 could grow to a solid $309,727 valuation, with an estimated annual dividend payout of $9,943, or about $829 per month. Overall, the total value added to my portfolio over these 30 years could reach $299,727, with $229,038 coming from capital appreciation and $70,689 from dividend reinvestment. And since most of my investment is in the core safe holding of the S&P 500, I'm confident that my investment after 30 years would be somewhere in the same ballpark. Want to know how to turn a $10,000 investment into a multi-million-dollar portfolio with ETFs? Click the video on the screen to find out. Please note, this is not financial advice, but simply my observation. Before making any financial decisions, be sure to do your own research. Ultimately, we are all responsible for our own bank accounts.